Hello everyone, so we'll get started in about a minute or so. So, hello everybody. I hope you've had a nice week so far. So, welcome to today's session when we're going to be talking about risk versus reward. Well, there are many different risks. Obviously, we don't have the time to talk about all of them when we deal about investing. But today, I'll try to, kind of zoom in and focus on a few of them and kind of highlight some of the riskier things out there, and definitely things that you probably should avoid, if you value your money, basically. All right, so let's get started, shall we? Okay, so you probably have seen something along these lines at some point or another. The easy trick to the wealthy don't want you to know, which makes me, or which can make you $9,387.42 per day, or something like that, right? You might have heard people tell you things like this. You probably have seen the ads, or used to see the ads a few years ago, up until about 2017, when in Canada a lot of them have been, when a lot of them were actually banned. Since then, some individuals kind of have started, restarted the trend to some extent, but flogging slightly different products with similar yet slightly different promises. And you all remember these ads. They were typically featuring, a ton of money, attractive looking people, typically females, and being like, look at this. If you do this one thing, you'll get, a nice car, potentially a girlfriend, and a ton of money. So who doesn't want that, right? So obviously, 99.99% of the time, these were either incredibly sketchy business practices or were outright scams. The few that weren't an outright scam were typically selling you various products that were what is known as binary options. I'll have a short video going into a lot more detail about binary options, exactly how they work and whatnot, in the near future. But all you have to know about binary options, like in the broad strokes type of thing, is basically someone tries to guess what the price of a certain commodity will be at the specific point in time. So you might say, well, I think Tesla shares will be this much. I think that pork bellies will be this much. I think a bushel of wheat at this point in time will cost this much. And if you guess correctly, or even the US to the Canadian dollar, their relative values will be X amount at 5 p.m. on December 1st, 2020, for instance. The reason these are very, very high risk propositions, again, they're binary options. So if you're right, you make money, you could double your money or triple your money. If you're wrong, however, you could literally lose all your money, and especially if it's money that you borrowed, now you both owe the money from the lender you borrowed it from, and as well as to your brokerage where you executed that particular trade. So typically speaking, unless you know exactly what you're doing, unless you're making sure you're dealing with a certified broker and everything, dealing even with options. If you know what you're doing, you can use options to reduce the risk of your investments. The riskiest options, though, are the binary ones, where basically you're either getting the trade right at a specific point in time, or you're getting it wrong. Some that are a bit less risky involve a few other steps, there are a few other checks and balances in the process. But as I said, that's a story for another day. So some of these kind of sketchy business dealings typically will require some form of expensive software, expensive training program that you have to purchase. And, they're going to say, I'll be teaching you how to make money like a million, how to make millions of dollars. This is how I've become a multimillionaire. But mind you, a lot of times when people tell you this, there's no way of knowing exactly how wealthy that individual was. I could easily, set up a nice, backdrop, or even, go rent out a place, an Airbnb place somewhere, walk around, pretend it's my giant mansion, and tell you that I'm a multi-gazillionaire. And, how would you know that I'm all that wealthy, or I'm just pretending to, right? So typically speaking, when someone promises you something that is way too good to be true, there's a massive, if not multiple massive catches. They will also typically require you that you use some form of very specific non-registered brokerages that might actually be offshore. The reason this is very sketchy is because, again, brokerages that are registered in Canada are typically, the vast majority of them are protected by CIPF. That's the Canadian Investor Protection Fund. And those ones, on the off chance that your brokerage goes bankrupt, in other words, in case they've leveraged too much money, in case they've been leveraging their money and they've been borrowing too much, and somehow they're struggling financially, at the very, very least, you will be able to get back the value of your investments up to $1 million per brokerage. Kind of that is guaranteed by the federal government. No one's going to pay you back if you're buying investments that are very high risk and the investments themselves tank, or if you lose out on the trade. But in case the brokerage goes bankrupt, as long as they're licensed and registered in Canada, that will be a lot safer. But again, most of these wouldn't be located in Canada for two specific reasons. Number one, it's a lot easier to scam people through non-licensed, non-registered or insufficiently licensed and not properly registered brokerages. A lot of times they might actually be owners of those specific brokerages and say, oh, well, the brokerage went bankrupt, oops. And then they would keep all or a portion of your money, and it would be very, very difficult to basically sue them in court after they declare bankruptcy in some other country. So what tends to usually happen with there we go. So that works. There's also usually either within the brokerages themselves or in general, there might be also hidden fees. So it's really all of these ads, all they do is, yes, they make the people creating the ads somewhat wealthy, or at least make them a good profit. Much less so for the person buying into the program, paying the fees, and risking potentially not losing access to their money if the brokerage goes bankrupt. A lot of these are also oftentimes pump and dump schemes where they might be selling you, for instance, penny stocks that they basically in advance they'll just buy millions of shares, or they might even be hired by the company that is trying to kind of drum up interest in their penny stock. And then they'll basically sell it to you at a ridiculously high price to either profit internal shareholders of the company that they themselves are the ones selling it, so they make a massive profit, or they might profit the brokerage itself that they're trying to sell it and make a massive profit. Now, normally here I would play you a video that kind of shows you some of these ads, because some of them made it onto YouTube even. There were short, 30-second, 1-minute ads that are clear pump and dump schemes, clearly, it's clear fraud. I'm not going to play it here, however, because last time I tried to do something like that, despite the fact that it's a clear disclaimer that I'm showing an example of a bad company and things to avoid, YouTube flagged my own video as being, a scammy video, and they got me a strike on my account, so which I had to fight, and took quite a while to get it sorted out with YouTube. So I don't want to go through that again. Needless to say that there are videos like that on YouTube. I'm not even going to bother including a link to it, because even if you're including a link in the description, it's also YouTube also is not very happy with it, because they think somehow I'm trying to tell you that the scam is real. But anyway, that's the YouTube algorithm for you. Sometimes it messes up in terms of what's kind of a public service announcement and what is an actual video trying to scam people. Strangely enough, the video itself, which was hosted on YouTube, wasn't flagged as a scam, but me talking about it and warning you about it was. So anyway, so just things to keep in mind. Now, this, as I said, has been done with options, typically with binary options, but also with certain fly-by-night cryptocurrencies and other very, very uncommon or startup tokens, basically. There are inherent risks to cryptocurrencies. They're typically very, very risky to begin with. But if you understand the risks, if you're fine with the risks of, potentially the exchange being hacked, or not really knowing what the value of Bitcoin or Ethereum will be in X number of months, weeks, or years, or what have you, that's, those fine. It's very risky. It might not be for some people. It might be worthwhile for others, right? But again, there are many instances of cryptocurrencies and tokens that literally were only created to to basically scam people and defraud individuals of their money. So while it might be very tempting to just buy one investment, whether it's a, some algorithm or some software that allows you to trade binary options or some other high risk gambit, the reality is more often than not, those tend to usually blow up in people's faces. And there might be outright Ponzi schemes and other sorts of scams as well. Now, as I was telling you before, so one of the reasons they're not typically, those brokerages are typically not located in Canada is because that way it's easier for them to basically sell you things that otherwise you wouldn't be able to sell in Canada. Number one, because they would need the proper registration and they would never get the registration required to begin with. And number two is binary options themselves are actually and have been illegal for a few years in Canada. So right now, since 2017, they've outlawed even advertising them. So I'm going to copy this. I'll put this at the end in the description of today's session. But here you have the link in chat in the meantime, right? So this is from September 28th, 2017, as you can see. And basically, security regulators announced a ban on short-term binary options because they're such high risk propositions. I'm not saying no one has ever made money on these. Some people have, but it's not the right type of investment. It cannot really be considered an investment. It's more of a gamble. It's for speculation. And it's only for really people doing this for a living or truly understanding what the risks are. And many times the risks are not properly represented to the general public. So that's something to keep in mind. And as I said, right now it's actually illegal in Canada. This is obviously the OSC, so that's the Ontario Securities Commission. They're the regulator of the stock market in Ontario. And it's very rare that a government agency will literally have a half-page warning on a subsection of their site talking about a specific type of investment in quotation marks. No company is authorized to sell binary options in Canada. A number of growing websites and companies are making claims about how quick and easy it can be to make money by trading binary options. No matter what they say, the truth is that none of these companies can legally sell binary options to Canadians. And that's not because the Canadian government is evil and doesn't want you to make money. That's because they're looking at the statistics, they're looking at the likelihood that you're going to lose money. And this is assuming it's not a scam, assuming the brokerage doesn't go bankrupt. Literally, even if this was a legit business proposition, it's an incredibly high risk business proposition. So stay away, basically. All right. And then basically, if you've fallen victim to this in the past, there are a few steps you can take and who to talk to, and so on and so forth. All right. And they kind of like to point out here that you should always check before you invest with the securities administrators in Canada to figure out whether the firm or the individual that you're dealing with is actually licensed, is actually registered. So basically, don't just open an account with some random online brokerage located in some, I don't know which country, that isn't registered or licensed to sell investments or talk about investments to Canadians, right? So that third link over there is basically where you can check the registration of an individual or a firm. So have a look at the firm that you're dealing with, the company that you're dealing with, and see if they're actually registered. Are they allowed to sell you and promote, investments in Canada? So at best, these are very high risk and speculative. So stay away. And here's a little game. This is called the Monty Hall problem. You might have seen this in the past, but this is basically how this little game is going to go. So you have 3 boxes, all right? So, and then I'm going to present you with 3 scenarios. One of these boxes contains a 100 kilograms gold coin, right? So you have the choice. Your option is to win 100 kilos of gold or 100 kilograms of potatoes, all right? Assuming in this case, 100 kilograms of potatoes is not a favorable outcome. So you get to pick one of these 3 boxes. And imagine we're we're playing a game, and I am the person that actually hid the 100 kilograms of gold in one of those 3 boxes, and I know exactly where it is. So there's 2 rounds to this game. Round number 1, you get to pick one of the boxes, right? In round number 2, I eliminate one of the boxes in which I know for sure the gold is not hidden in, right? So I will unveil one of the boxes that basically contains the potatoes. So then the question is, do you stick with your original pick or do you switch to the other option, right? So initially you have, when you have no idea, you have no information about where the gold is. So you have no idea which is the risky box and which is the reward box. You have a 33% chance of getting right just off the bat, right? 1 out of 3. And now let's say there's 2 individuals playing this little game. Individual number 1 always sticks with their first choice. They say, well, first time around, I have 1 out of 3 choices. And then even if you eliminate one box, there were still initially 3 boxes. So I still have 1 out of 3. So I'm going to just stay with my initial choice because it's just 1 out of 3, right? The second player, every single time that I'm going around and eliminating one of the 2 boxes that I personally know contains the potatoes instead of the gold, that player always switches. And the question is, would you prefer to be player 1 that always sticks with their first choice? Or would you like to be player 2? And at the end of the day, are they equally likely to win out? Well, let's have a look at what happens. So keep in mind, player 1 always sticks with their first choice. Player 2 always switches. So they both pick, let's say the first time around, they pick the first box over here. So they pick box number 1, all right? Now, because I know which box contains the gold and which one contains the potatoes, I'm going to reveal box number 2 as being the box that contains the potatoes. Now, you personally at home, think about it. Would you like to stick with your option number 1, or would you switch over to this other box, right? Because at this point, you know that this box no longer contains the gold, right? Because I've already shown you. So again, player number 2 switches over. And in this case, what everyone hopes for is that if you decided to stick with your own first choice is that, well, initially I had 1 out of 3 chances of winning, so might as well stick with my original choice, right? And sure, you're hoping that that's the case. And yeah, that can happen. That can definitely happen. Now let's play this game one more time. And now in second scenario, same thing, both players pick the first box. Now I reveal, let's say that this box is empty, right? Last time this was the empty box. Now this is the this is the potato box. So obviously, per the rules, player number 2 now switches again. Now, in this case, right, in the first scenario, you have 33% chance of that being in the original first choice. In this case, it was correct. In the second case, it was wrong. So the gold has to be in the other box since I've already unveiled one of the 2 potato losing boxes, right? And then finally, the third scenario, well, where's the third place where the gold can be? Well, it's over here, right? So if you selected this as the first option, same thing, player number 2 now switches over to the other one after I unveil an empty box. Again, this only works if the person that you're playing this game with knows where the gold is and always unveils a box of potatoes on the second go, right? So in this instance, player number 2 won 2 times out of 3, and player number 1 won 1 time out of 3. In other words, player number 2 actually has a 66% chance of winning, whereas player number 1 has only a 33% chance of winning. So player number 2 is twice as likely to beat player number 1. The reason I'm giving you this little example here is because if you think about it and think it through, it might be a lot more obvious now that it's always worthwhile switching over, because the second time around, your second choice has basically a 55% chance of being correct. The first one only had a 33% chance of being correct, but because you basically get to pick 2 of the choices if you're switching every single time you go, you literally will win 2 times out of 3 if you repeat this enough times. So sometimes risk, it might just be that the underlying investment might just be riskier overall, but it is really difficult for a lot of people to understand all of the underlying risks and all the underlying potentially complexities of what's happening, even when the situation is not really that complicated once you really start looking into it. So if you think that this, if you want to kind of try this out for yourself, you can kind of play this little game here, which basically you can run the simulation over and over and over again, and you can basically see what happens if you keep on picking, or if you're switching, or if you're staying with your original guess initially, right? So if you're switching or you're staying with the original one, and then it keeps track of how many times the switcher has won versus the person that hasn't switched. And you can play that as many times as you want. All right. All right. So now this brings us to different types of investments and their relative risks. So if I asked you, what is higher risk? Is it having a savings account? So let's just say high interest savings account, is Canadian stocks. Would it be bonds, international stocks, real estate, or perhaps would it be actually, no, that's pretty good. So which one of these would be highest risk? So a lot of times, again, people would say, well, obviously, high interest savings account, that's obviously the lowest risk. And most people agree that, that's basically lowest risk. 2 would be the second lowest risk. So bonds, it's not that difficult to understand that bonds are second lowest. And then people would typically put, they would probably put, a lot of people would be tempted to say that, well, real estate is safer than stocks, obviously. And if your choices are individual stocks or one house, to some extent, you're probably correct. Although even that might not necessarily be always true. However, if you were to actually look at how likely you are to sort of gamble on real estate versus if you were to just buy a broad market diversified portfolio, in many instances, real estate is actually quite a bit more risky. Why? Because a lot of times people will use a lot of leverage. So they'll use a lot of borrowed money, meaning that if they're unlucky enough in their specific real estate investment doesn't keep on just going up and up and up and up, they risk not only losing a good chunk of their deposit, but they also can lose exponentially more money compared to what they've put down. Because keep in mind, in Canada, you can have only a 5% down for any mortgage that is $500,000 or less, which means you're 20 to 1 leverage, right? Leveraged. Meaning, right, you put down one part, the bank lends you 19 parts of it. So out of the total 20, you get 1. So 100 divided by 5 gives you 20. So then obviously, if the value of your real estate goes up by $1, then you've made $20 on every dollar that the value of your real estate goes up based on how much money you've put in. But if it drops by $1, then you lose $20 for every dollar that it drops. Now you might say that, well, look, even in July and August, real estate prices have been booming in Canada, even in the middle of a pandemic. Obviously, real estate is safer. Don't be so quick to judge. There are instances, different subtypes of real estate have actually been declining and declining significantly in many places. Certain areas of Canada have been declining for a few years already. Some have been declining more so this year. So just because most of Canada or many places around Canada have done really well in July and August, mostly because we're at record low interest rates and we don't have, there was no real spring market. It doesn't necessarily mean, and most certainly doesn't guarantee, that real estate can just go up and up and up. So overall, Canadian stocks are actually, and foreign stocks are actually slightly less risky than real estate, provided you're buying an index, or you're buying many different types of stocks at the same time, not just picking individual companies, right? And now, why are Canadian companies or Canadian stocks of Canadian companies less risky than foreign ones? Then, well, it's mostly because those companies deal in Canada, and as a result, you don't, and they're dealing in Canadian currency, so you don't have any foreign currency risk, and because of that, any fluctuations, because let's say if those companies do really well, but the Canadian dollar increases in value compared to the other foreign investment. At that point in time, even if the value of your investment, let's say, goes up by 10%, if the value of the relative value of the Canadian dollar increases by 11% compared to the other currency that your investments are in, then you will have only really made a negative 1% loss, right? 11% depreciation in the value of the currency, that currency compared to the Canadian dollar, right? Versus 10% gain on the investment itself. And again, this is not from me. This is well known. It's just a summary over here in a short 2-pager kind of infographic that you can find on one of the Ontario Securities Commission's websites. I've used this one in the past, and I'll revisit it to some extent in the future as well. So again, sometimes risk is not that obvious. For many people, again, they might be tempted to say that real estate is actually lower risk than stocks, which is not the case. And now you might say, well, here they're saying real estate investment trusts. They're not talking about individual homes. Exactly. They're talking about real estate investment trusts, which are companies that invest in hundreds or even thousands of different units. They might be individual houses. They might be entire apartment buildings. They might be industrial complexes. They might be commercial real estate, and many other forms, right? And yes, even that is riskier than stocks, broad diversified stocks in general, right? Real estate investment trusts are part of this, but they're just one section of it. So that particular subcategory is actually higher risk. But an individual home, that's even higher risk. Why? Well, because again, you cannot really take 20x exposure and being leveraged 20 times when you're buying real estate investment trusts. The limits are between 3 and 5 times, depending on which country you're in, typically. So an individual single family detached or apartment is actually even riskier than a real estate investment trust, right? So that would be, your home would be up here. Now, don't get me wrong. If you're doing your research right, if you can actually afford it, that's fine. Just realize that there are legitimate risks involved. And in the vast majority of cases, whether, again, there's a bad actor deliberately trying to lie to you and con you, or whether you're kind of tricking yourself by believing something is a lot safer than it is. Again, when something seems too simple, too easy, that everyone just buying real estate in Toronto and Vancouver has made a ton of money. Yes, there are a lot of people that have made a ton of money in the last decade or so, but there are also people in the last decade or so that have lost quite a bit. Right? A lot of people right now are no longer able to afford their mortgages because they lost their jobs, because they were over indebted to begin with. And yes, it's not fair to say that, well, people didn't foresee the pandemic, so it's their fault. No, okay, that's not a fair statement. No, very few people, if any, have really foreseen this mess. The point is, if people had purchased real estate they could reasonably afford, even when you have significant issues such as a pandemic or a massive market crash or anything like that breaking out, at that point in time, they would have fewer issues servicing their debts. Yes, it might be very tough few months, but they wouldn't have to rely on, hopefully the government allows them not to pay their mortgages for 6 months, because otherwise they would have to foreclose on those assets, right? All right, last little piece of info here. If you're looking at individual stocks, so again, just because I'm saying a balanced diversified portfolio is lower risk than real estate, and that in turn is lower risk than some gambling on cryptocurrencies, especially the smaller, less known ones, which might be scams, and that in itself is about as risky or less risky than binary options, which are illegal in Canada, whereas at least buying cryptocurrency is legal, although still very high risk as well. There are also issues with stocks, and specifically individual stocks. Why? Well, people hate losing money. As a result, people will hang on to losing positions in their stock portfolios for much longer than they really ought to. And they will even worse, they'll throw good money after bad. In other words, let's say they bought some stock that at a certain price. So let's imagine you buy a stock for $100, right? Now, if it drops in value by 1%, right? That means you lost $1, and right now its value is $99. Not very difficult, right? But again, people hate the idea of losing money. As a result, many people will hang on to a losing investment and pile in more money into that investment. Now, obviously, if the company recovers, that's a way to dollar cost average and make quite a bit of money. However, for individual companies, especially smaller startups or especially penny stocks, it's incredibly risky. Again, not as bad as binary options, but it's not for the faint of heart. And the other thing that you have to realize is that mathematically speaking, when you're going from $100 to $99, that $1 represents 1% loss. But in order to break even, $99, 1% of $99 is not $1, is 99.99 cents, right? So in order to make a full dollar, you need 1.01%. As a result, the difference in percentage in terms of how much percentage you have to recover is 0.01 between 1%, between losing $1 and regaining that same dollar, because you're starting with a smaller sum. Now, this might not seem like a big deal if your investment tanks by 2, 3, 5%, but you have to realize that if real estate drops by 5%, right, it has to go up by 5.26%. If it drops by 20%, it has to go up by 25%. If a stock drops by 30% in value, it has to go back up by 42.86% to break even. So this is why when stocks corrected on average for around 35% back in March 23rd of this year, that's when the bottom was reached pretty much, and we were around at a 35% correction at that point in time. A lot of the markets have recovered, but basically to break even, you would have had to go up, the market would have had to go up by 53.85%, which again, most markets, especially the US, NASDAQ, for instance, tech stocks, have gone up by quite a bit and quite a bit more than that. Although, again, recent days, it's sort of been tapering a bit further. So the key takeaway here is the more your stock drops, if you're buying individual stocks, the harder it is for it to recover if you're looking specifically at percentage values. So imagine you bought a stock that dropped by 90% in value. So you might feel bad. So, right, just selling it would be some form of confirmation that you've messed up and that you weren't smart, that you didn't make the right investment. People hate to be wrong and people hate to lose money. So they want to at least break even, right? But that would be very, very naive to just wait for that. Usually, in some cases, it does recover, but that's a gamble. This is what I want you to understand. Just because something it was worth a certain amount or was trading at a certain amount, X number of days or weeks ago, doesn't necessarily mean that it was properly valued and it was actually worth that much. There might have been just a perception of worth. So if something drops by 90% in value, for it to recover, for something that goes from $100 drops by 90, now is worth 10, that investment would have to go up 900% to break even. In other words, the difference in percentage is 810%. So if you were to buy any given investment right now, how realistic do you think that investment should go up in value by, 700, 800, 900, 1,000%? Obviously, you would say, well, that's highly unrealistic. Well, yes, but if you're buying something at the elevator price and it drops, then this unrealism tends to kind of escape most people's minds, which is the wrong approach to have. All right? So the take home there is the higher your percentages. So once you lose 50% of an investment, it would literally, that investment would have to double in value then just for you to break even. So this approach works perfectly fine if you're looking at ETFs because you're spreading the risk. ETFs because you're spreading the risk among the hundreds or even thousands of different individual stocks that that ETF is holding. But if you're doing it for individual stocks, you're increasing, you're potentiating the risk in case you're betting in the wrong direction and the market moves in the opposite direction to what you hoped it would. And to illustrate this for every single, percentage point, this is the difference. This is the difference plotted between the percentage drop to the percentage gain. So basically, if something drops by 95% in value, it would have to go up by 1,900% from the low price just to break even with the original price. And this is basically that, exponential growth curve that you see here. And again, if something drops in value by 99.99%, it would have to go up to, by about 10,000% to just break even, which is ridiculous, as you might have guessed. So, what is the main takeaway from this discussion on risk in general today? Well, I think this image pretty much sums it up very, very nicely. On the road to your financial success, unfortunately, there are no shortcuts. Slow and steady wins the race usually. There are certain investments that are slightly higher risk investments that might be right for some individuals, but make sure you understand what those risks are. This is why I showed you that Monty Hall example with the 3 boxes earlier. All right. So that. And then basically, if something seems too good to be true, it most likely is. So stay away from things like, binary options trading and most cryptocurrencies that are just starting out. If you don't mind losing that money, if you're fine, you're putting a relatively small amount that you don't mind losing, it's fine, I guess. It's a gamble. The same way that you're, buying lottery tickets would be even less likely to make you any money. So might as well buy crypto at that point in time. But do not, mortgage your home to buy, especially the smaller cryptocurrencies. It's incredibly, incredibly high risk. So higher potential returns virtually always involve higher risks. Make sure you understand the risks involved. That's incredibly, incredibly important. Something that is right for one person might be the wrong thing for another. And again, most people's understanding of certain risks is very much incomplete. And that might be because of a slight mathematical trick, if you will, or it just might be that you just aren't aware of what are the other inherent risks to that investment is. All right, so I hope this kind of highlights this interesting dichotomy between risk and reward. And the links that I've provided you in the chat and that I will post in the description of this video once the live stream is done will be helpful to at least provide some entertainment when it comes to how risky are different types of investments and then how much risk is there involved with different types of transactions. So this is pretty much all I had for you today. I hope you found this useful and see you next time at a future session. Have a good one, everyone. Take care.